If you're living in this present age, you cannot deny that there's so much emphasis on investments. Everywhere you look, you're hearing stories about someone who made a terrible investment decision or someone who's lost all their fortunes to shady deals. Either way, it's been thrown at your face daily. Let's face it, sometimes it can be annoying, especially when you don't see the need for these investments. But as much as we might not admit it, we do need to know all the financial lingo and understand completely what each investment means to us and what it offers our future. This is why in this video, we're going to be talking about the VFV ETF and why you should or shouldn't invest in it. Hey there, welcome to my channel. If this is your first time, I'm glad you made it to this video. Please subscribe to my channel and click on the notification bell so that you get updates whenever I upload new content. If you've been here before, thank you so much for finding your way back, and don't forget to like this video. Before we go into the VFV ETF, let's talk about what the ETF in general is. What are ETFs? ETFs, also known as exchange traded funds, are investment funds that are traded on stock exchanges. They are put up for sale publicly and contain assets such as stocks, shares, bonds, and so on. Most ETFs are index funds, which is a type of fund where the goal is to imitate the market rather than trying to beat it. The most popular ETF is at this recording is the S&P 500. ETFs can either choose to be transparent or non-transparent. This means that they could choose to expose their daily dealings or their properties online or not. Transparent ETFs, however, choose to show the list of stocks they own as well as their weighting on their websites every day. ETFs generally have an annual fee or an expense ratio of about 0.03% to 1%, depending on the one which you choose to patronize and how much you choose to invest. ETFs divide ownership between shareholders, making it possible for them to participate in owning percentages of the company's shares. This means that they indirectly own the assets of the fund and get annual reports. They also earn interest and dividends from the business. ETFs are a good form of investment because it offers their customers low-cost services, taxation, market diversification, and transparency. Its low-cost service is what makes it possible for people who are not millionaires to be able to invest. It is pocket-friendly and inclusive when it comes to pricing. And even though you invest so little, if you're patient enough, you get to receive so much dividend in return. Market diversification, as I've mentioned earlier, is another reason why people invest in ETFs. ETFs are not dependent on one particular sector of the economy or on one company to thrive. They invest in several companies and several sectors, and in the end, if something happens to one of these institutions, they will not be so greatly affected. In simple English, or in simple terms, they don't put all their eggs in one basket. Lastly, the ETFs offer some level of transparency, and this helps to put the minds of investors at rest in terms of their money. Now, let's talk about VFV ETFs, simply known as the Vanguard S&P 500 ETF, is an investment whose goals are to track the performance of the S&P 500. It is a largely diversified index, predominantly made up of value stocks of large US companies. VFV uses the indexing investment approach as a means to achieve this. In this system, the advisor attempts to replicate the target index, in this case the S&P 500, by investing all or some of its assets into the stocks that make up the index and holding each stock in approximately equal standards to the ones in the index. Now, the pros of choosing the VFV outweigh the cons, and some of them include: 1. Its low cost, effective tracking, and simplicity. Compared to the other funds, especially the mutual ones, the VFV ETF doesn't take as much from investors in the name of management fees. It has an MER or management expense ratio at a rate of about 0.09% per annum. They also pay their investors dividends quarterly. Secondly, the VFV ETF has very close tracking to the S&P 500. This means that they've managed to study the methods that this index thrives on and can replicate it excellently to around 99%. So, They enjoy as much success as the S&P 500 does and provide their customers with the best. This ETF has managed to keep things simple for its audience, taking them every step of the way so they know where their money is going and how it is growing. They are transparent, simple, and this makes them a more effective choice. One downside to this whole system is that they're more dependent on the tech sector than any other sector available. This means that they will suffer great losses if there is to be a crisis in the tech industry. As much as they're diversified to a point, many percentages of their investment go to tech companies all around the US. Now, I hope this has helped you understand the Vanguard S&P 500, also known as the VFE, and now it's left for you to decide where you want to put your money or where you want your money to go. If you've enjoyed this video, please subscribe to the channel and leave a comment below. And if you're already into financial investments, you can drop a comment to let me know what ETFs are worth looking at and how it's been going so far. Don't forget to share this video with your friends. I'm Peter, and I'll see you in my next video. Bye. Hello and welcome back to this channel. My name is Peter, and today I'm going to be talking about something quite interesting. It's called the behavioral finance bias. And regardless of if we want to hear this or not, many of these investment decisions based on these biases have led to not very desirable results at the end of the day. For some, it had worked out well, while for others, this is just not the case. With that, this video is going to be exposing you to various behavioral finance biases that have been at the forefront for investors making decisions on their investments. So make sure to get yourself comfortable and pay close attention as I'm going to be addressing these various issues. Now, before we get deep into this topic, let's first understand what behavioral finance bias is. When I talk about behavioral finance bias, this is basically the insane ways our brains make flawed financial decisions. While many people like to think that they are logical with their financial decisions, this is sometimes or most times not the case. Let me explain why. Somehow, we all find it easier to constantly yield to crazy amounts of cognitive biases that have way too terribly warped the money choices that we make. And so this begs the question, why are people so bad when it gets to making money choices? Well, the answer to that is that this is a software problem. And when I say software, I mean the brain software problem. When you look at it, over all these years, humans have continued to evolve, and this has brought about civilization. However, even though we have continued to evolve, our brain hasn't exactly done just that. And what I mean by this is that when we are faced by modern problems, our brain doesn't exactly respond to modern problems the right way. And this has led to behavioral scientists studying the way the human brain tends to stumble when it gets to making money decisions. First of all, it is important to know if you're good at managing money by taking this simple example. Let's say a journal and a pen cost $1.10 together, and you're told that this journal costs $1 more than the pen. How much does the pen cost? This right here is a good example of cognitive bias, also known as cognitive reflection. And that simple game just measured how much we could override our wrong gut response and our ability to spur the much wiser brain. However, I don't want to keep you waiting because the answer to that question is the journal actually cost $1.05 while the pen costs 5 cents, making it a total of $1.10. Yes, I know, I got it wrong too. And with that, behavioral finance shows how terrible we are at taming our regularly misplaced instinctual brain. While the list of these biases is endless, one that's very recurrent is the correlation bias. This simply is the brain's tendency to convince us that random acts are correlated with other random acts. For instance, just because you were able to time an equity purchase and gain so much more than you ever had, you now start to think that you're a savvy investor. So, according to random chance, we're somehow regularly led to believe that we'll always get to win in the market, and the brain does a good job in making us forget the losers. While this may sound like fun, it has led to terrible choices in the past because the overconfidence and the complacency lets you to believe that you're always going to win, and when you eventually lose, it becomes very terrible because you didn't account for the fact that you could lose. Then there's the false memory bias. This one is quite tricky because it lets us remember events that never really occurred that way to fit a particular narrative that we're trying to portray. You can see how this is going to be very dangerous when making investment choices. Another one is the availability heuristic bias. Not sure if I'm pronouncing that right, but this is simply the bias where investors are over-trusting the facts that could be pulled from one's memory without checking it. Also is the neglect of probability, where the brain tends to be insanely wrong about the risks that may lie ahead and how it may end. Another type of bias would be the survivorship bias. This one is very common with new investors and sometimes with experienced ones. Here, investors tend to have so much trust in the opinion of winners, and they tend to discard the opinion of people that have lost at some point. But here is one conclusion that many behavioral finance researchers agree on. In most cases than none, the market can be held responsible for the disaster that happens to many people's financial future. Rather, the biggest and real hindrance to wealth is always us and the careless meddling that the human brain pushes us to do. Ever notice that sometimes you're caught in between leaving the market or staying in it, and immediately you do something, the opposite tends to happen? Either the market skyrockets or it plummets. And when this happens, the instinctual brain goes wild and we're put into fight or flight mode, and we start to panic, leading to many unnecessary decisions that could put our financial futures at risk. So now that we know all of these things, I would advise that you go deeper into your behavioral finance education as soon as possible, so you don't continue to make money decisions based on any of these biases. If you found this video helpful, let me know by hitting the like button. And to be a part of the regulars, make sure you're subscribed to the channel, and don't forget to hit the notification bell so you never miss any updates. Thanks so much for watching. I'm Peter, and I'll see you in my next video. Hello and welcome back to Hint Hive. I'm Peter, and today I'm going to be talking about your credit score and how to improve it in a place like Canada. If you're new to this channel talks about personal finance tips to help you on your way to financial independence. So if that sort of content interests you, don't forget to hit the subscribe button so you can get notifications when I post a new video. So what is a credit score? A credit score is a number usually between around 300 and 850 that rates a lender's confidence in a borrower's ability to pay back their debt. Your credit score will determine, for instance, what terms you're offered on the loan and how high your interest rate is going to be. Credit scores are based on your credit history, which could be the number of accounts you have, how much debt you have, and so on. Lenders, in turn, use this info to determine the likelihood that you're going to pay your debt in a timely manner. Now, there are different credit bureaus in Canada. One you likely know is TransUnion, which is very common, and the other one is also Equifax. Why is your credit score important? Your credit score can have a major impact in your daily life. It affects whether you could get approved for loans, it determines the interest rates in which those loans would be, and in some cases may even be looked at by prospective employers. And even sometimes, service providers and utility companies also use your credit score in decision making. Now, an important part for you to know is how do credit scores work? In simple terms, the higher the credit score, the better. So credit scores above 700 are usually considered good. You may get a lower interest rate on your loan or credit card, meaning you get to pay lower interest over time. Credit scores above 800 are considered excellent on the other hand. Shifting to the other side of the scale, for example, people with credit scores below 640 are usually considered as subprime borrowers. And in this case, some loans could charge a higher interest rate for carrying a higher risk to compensate the lender. Other requirements may be a shorter repayment term or a cosigner for lower credit borrowers. How is your credit score calculated? There are 5 main factors that determines a person's credit worthiness. The first is your payment history, so how well you've been paying your loans on time over time. The next is the total amount owed, So how much you're owing from all other credit sources at that particular time. Next, you look at the length of your credit history. So how long have you had a credit card? How long have you had credit history since you got into Canada before applying for that particular loan? The other factor is the types of credit you have. Is it a mortgage? Is it just a credit card for regular expenses? And finally, any new credit on your account. And if you usually grade this over 100, around 35% goes to the payment history, which helps see if they've paid their obligations on time. Total amount owed goes to about 30%. This takes into account how much credit a person has available and how much is owed, and what percentage of it is being used currently. The length of your credit history can make a big difference in how banks measure risk. Longer histories are generally considered as less risky because there is more data to accurately measure the person's repayment obligations. Generally, if a person's score is high, it will show that their mix of installment credit and revolving credit ranges from bad to good. New credit counts for a score of around 10%, and factors among other things like how many new accounts a person has, applying for too many new credit cards or inquiries. Now let's look at how to improve your credit score. When information on a borrower's credit report is updated, their credit score can change. Sometimes it will go up and sometimes it will go down. But here are some ways that you could improve your credit score in Canada. The first one is ensuring that you pay your bills on time. Yes, it could take up to 6 months of consistent on-time payments for your credit score to change for good, but it's always good to ensure that you get your payments done on time. Another one is calling your credit card company to increase the limits on your credit card. If you have a good relationship with your credit card company, chances are they're going to increase the limits on your credit card at some point, even without you calling. This in turn helps you reduce the amount spent and the entire credit available to you, assuming you don't increase your expenses, which in turn reduces your credit utilization rate to below 30%. And this would translate into helping you improve your credit score because you're not using as much from your credit card. Now the third one, even though quite controversial, could be do not close the credit cards that you're not using. It's advisable that you just keep them and not use them, because take for instance, you had $2,500 on credit card A and you had $2,500 on credit card B, making it a total of $5,000 available to you as your credit limit. Assuming you spend $1,000 out of that $5,000, the account would be considered good because your credit utilization at this point is just 20%. But if you close one card and now you have only $2,500 and you still spend the exact same amount, which is $1,000, your credit utilization goes up to 40% because 1,000 out of 2,500 is 40%, and now you're considered bad because your credit utilization has now gone up from 20% to 40%. So it's better if you're not using a credit card, just keep it for a while your credit score starts to go up before you eventually close it, or wait till you don't need it for any application so far before you close it. If you do, however, consider to keep them, always make sure once in a while you go to check to make sure there are no pending charges or your account has not been hacked and someone's spending out of your credit card for any reason. These are some of the ways that you can improve your credit score in Canada, especially if you're planning something huge, like maybe real estate down the line for a potential investment. That's it for today. If you found this video helpful, don't forget to hit the subscribe button and share to anyone that you feel might benefit from watching this. Till next time, thanks for watching. I'm Peter, and I'll see you soon. Hello guys, and welcome back to the channel. I'm Peter, and today I'm going to be talking about what causes inflation in Canada. If you're new to this channel talks about financial independence, tips and tricks to help you on your way to financial independence, financial literacy, personal finance tips, and all that kind of good stuff. So don't forget to like, share, and subscribe if this sort of content interests you to help grow the channel. So what is inflation? Inflation is the general increase in price over time. And if you know what's happening right now, you know that Canada is struggling with high inflation rates and the government is trying to bring it down. But then again, it got me thinking what causes inflation and the results would kind of surprise you, or at least it surprised me. So let's go. So generally with inflation, when the supply of money goes up, prices tend to follow. And some of the causes of this could include 1. Printing more money, printing and giving away more money to citizens. While this is a good thing sometimes, it could also lead to inflation, or generally it leads to inflation as well. The next could be legally devaluing or reducing the value of the legal tender currency. And a third one could be loaning new money into existence as reserve account credits through the banking system by purchasing government bonds from banks on the secondary market. This is usually the most common method. And in all these cases, money loses its power. And what happens here is that there's 1. Demand pull effect. Let me explain that. Now, demand pulled inflation is when the rise in supply of money and credits in the economy leads to increased demands for goods and services. Basically, when there's more money, people want more things, and then the production can't keep up, making the prices to increase. So basically, when people have more money, we're definitely gonna see more spending. Does that sound familiar? It does, because during the COVID-19 lockdown, the government was issuing out support to citizens by giving out a certain amount every month to those that were unemployed or met some certain criteria. While this was good, it then led to more spending because guess what? Now, if a certain individual wants to buy something worth maybe $100 before, and somehow they can now buy this for $110 because that extra $10 was free money, which is the sweetest money to still spend because that particular item is not available or is scarce. I can pay, or the individual can now pay an extra $10 just to get that item. And that leads to what? Bidding. And that leads to driving the prices up. And that leads to having the highest bidder win. But then again, after that, the prices don't just come down. They stay that way because from the producer's standpoint, who doesn't want more profit? See where this is going? Now, the next is called the cost push effect, which causes inflation. So, back to the COVID situation. When everything started going up, the demand for things started going up because of more money in the economy and people willing to bid more. Now, everything is scarce because there's a supply chain lockdown or a supply chain pause due to COVID. Now, this causes the producers a tougher time in getting the materials needed to produce. In effect, the materials needed to produce things become scarce, leading to a rise in price. So now, the demand pull effect has translated into the cost push effect, and all is driven by the human nature to want more, to acquire more, to get our needs met at every point in time, which is natural. And now this final one is called the built-in inflation. And this is strange and funny because it affects all of us. Now, we've ascertained for a fact that the prices of things are going up. Gas bills are going up, electricity bills are going up, utilities generally, everything is going up. Housing, food, everything. So, when this happens, it is expected the prices will continue to increase in the future. So at work, employees start to predict that this thing is going to keep going up. And as a result, they demand a raise from the employer. Now, once the employer gives the raise, they start to afford those things that keep going up. And as a result, the employer is not making as much money, so they have to also increase the price of their goods and services. So imagine a certain employer, maybe let's even pick a random example, a grocery store. They start to pay their employees more to keep up with the inflation and rising cost of other things outside the grocery store. But now, that employer has to make that money back some way because they can't be losing since they need to sell groceries. So where did the price increases go to? The groceries that they sell. And that in turn affects outsiders coming in to buy groceries. The same thing happens everywhere. The automobile sector, energy sector, housing sector, everything. So that's how, as humans, we kind of play a big part in causing inflation for the country. But then again, you would ask yourself, so what should I do? Would I not try to increase my wages just to match up a cost? The answer is you have to, because if you don't increase your wages, everyone else is increasing their wages. and then you're still going to face the inflation anyway. So when looking at what causes inflation, it's kind of funny because it's actually we as humans that cause the inflation based on the desire for our needs to be met. Let me know if you've thought about it this way or if these examples make sense to you. Because after looking at it for a while, it kind of sounds like we also have a part to play and we are at fault for the inflation. But then again, there's really nothing much we could do about it, except now that the government is trying to increase interest rates to try to steady inflation and not get into a case of deflation. So I'll stop here today, and this was what I thought about during the week, and I figured I should share with you guys just to see what you think. If you like this video, don't forget to leave a thumbs up, like, share, and subscribe to help grow the channel. Till next time, I'm Peter, and this is Hint Hive. Thanks for watching. I'll see you soon. Hello and welcome back to this channel. I'm Peter, and today I'm going to be talking about how to save money as an international student in Canada. I was an international student once, and if you find ways that you can save money at any point in time, it's always a good thing to have. So if you're new to this channel talks about personal finance tips, investment tips for beginners, tips that help you grow on your way to financial independence. And if that sort of content interests you, don't forget to hit the subscribe button so that you can get notifications whenever I post a new video. So, how to save money as an international student in Canada. I have a few points outlined here, but let's talk about it for a little bit. You know, as an international student, the culture shock, different things that happen within the community as you get into Canada, it takes some adjusting to. And one of the things that if you're not careful could quickly eat into your savings or the savings you have for your studies is your expenses. So having to adjust in a place like Canada, where it's quite different, like for instance, I'm from Nigeria and it's very, very different where I'm from. But having to come to Canada and trying to learn how the new system works, it's quite difficult if you don't have things or resources to guide you. So one thing that helped me was looking for school resources and grants. In my time, there was something about a $2,000 grant for international students if you apply for it or if you met the criteria for it. And I applied for that. So something like that, you could look for it in your institution just to see if there's anything that can help ease the burden on your international tuition or ease the burden on your expenses as you try to transition from a different environment into this new one. So there is no shame in asking for things like that or trying to find out if things like that are available if you get to save money from it. Next is trying to plan yourself for your courses and trying to pass them at once so you don't have to take them again or withdraw if you feel like they're not the right fit for you. So doing a course-based master's when I came into Canada, I realized that I had to pick my courses, and if I didn't pick them right or try to pass them at once, meaning the minimum criteria of course, you would have to take them again. This in turn would lead to more money spent on your end as a student just because you have to pay for those courses again, which is not really a good thing, especially if they're 2.5 times more expensive than domestic. The next point is working part-time to supplement your savings. So in Canada, at this point of recording, I think you're allowed about 20 hours a week as a student. Even if you have sufficient money for your living expenses and tuition, it's always good to have that supplemental income so you don't run out of money fast. Think of it like a bucket filled with water and there's a hole at the bottom. It keeps dripping water, which is your tuition, your money, your living expenses, everything just going down the drain. But you need that supplemental income to at least reduce the rate at which that money goes down before you're done schooling. Another thing you could do to save money as an international student is sticking to necessities. So basically sticking to what you need at that particular time to get through your international studies. I noticed that where I'm from, which is Nigeria, is quite different from here in Canada. Some stores offer payment plans for different things that you need, but you have to be disciplined to know what you need and what you don't need. Otherwise, you end up acquiring everything because you can easily afford it on those payment plans and you go into bad debt. Another point could be finding a roommate to share the cost of living. So when you're coming into Canada as an international student, the cost of living is one of the important factors you need to consider, because the school's accommodation, even though it's quite good, in my case, it was way higher than living outside the campus. So what I did was to find a shared apartment, so where you share utilities or common areas like the kitchen and the living room, just to cut down on the cost of living. And this in turn saved me approximately about, calculating it now, it looks like the difference was like almost $300 every month. That is something that I could put towards like feeding or grocery shopping or trying to do other things like getting books or whatever I needed for school, for instance. And even though it wasn't as comfortable at some point, just coming in, staying in the hotel, trying to look for accommodation, I figured out that like this was eventually the better move for me, because school accommodation was just too high and I could get the same thing for less just by staying close to the area, about 5-10 minutes away from school. Another tip to save money as an international student is staying close to the school. It's not just the fact that you have to find an accommodation maybe a little bit outside of the campus, but you need to make sure it's in close proximity to the campus. This is because sometimes during winter, especially in a place like Alberta, you could miss the bus. And if you're living very far away from school, you have to take Uber just because you don't know the way to school or you don't have enough time to get to school before your next lecture. But if you're staying close to school, once you miss the bus, the school sometimes, like from my house at that point, I could see the school. And although it was cold, it wasn't really far because I was staying quite close to school. That helped me save money just because I didn't know the city too well. And if I was staying very far away, I would have been forced to maybe book an Uber or something like that. Another thing that came to my mind right now is like trying to learn how to cook. Just because you need to be cooking at home to be able to save on costs from like buying food from restaurants and stuff like that. Because as a student, most times you're really tired after school. Sometimes then my studies used to end like around 9 p.m. or 10 p.m. And before I get home, I'm already so tired that I just want to eat something and sleep. So knowing how to cook made me prep my meals ahead of time. So like on a weekend, for instance, I'll cook for the whole week, save money on that. So that way, instead of coming home and having to order maybe pizza, not like there's anything wrong with pizza, but like instead of having to order pizza every single time, I'd rather just like heat up a plate from the fridge and just move on. And when you look at it, cooking at home kind of helps you save on a lot. At one point, I tried to analyze the difference between when I cooked at home and when I ate out. It was quite significant because I was saving almost like $400, $500, assuming I ate the same meal outside rather than cooking it at home. Another way to save money as an international student in Canada is to look for discounts. So look for coupons, look for store discounts. Always ask before you buy anything. Yes, it might look very crazy, but like I've gotten so many discounts just by asking. But before you buy anything, always ask, is there a student discount for this? Aside from a regular discount, but a student discount. Because sometimes you never can tell, like you could save on products like electronics, laptops, just by being a student and showing your ID. So always ask for that because you can save money on things that you need to have just by being a student in Canada. And to wrap up this video, this one thing helped me save a lot on some of my school expenses as an international student when I came to Canada, and this is utilizing credit card rewards. So then I had a cashback credit card where I could get maybe like, I think it was around 1% cashback on every of my purchase. So aside from getting a student discount, I still purchased that with the credit card and you still get a 1% cashback. So the thing is, if you had $100 to buy something, you could as well just use your credit card and pay $99 because you get $1 back in cashback rewards on a 1% cashback. So no point buying things in full when you can get a discount and still get a cashback on that. These are the things that as an international student, you need to look out for while you're in Canada, just because some of these things, they're out there and some you have to ask for them just to be able to get them. Even like your phone bills, everything, you could always get a student discount if you ask. That's all I have for you today. If you're an international student in Canada and this video was helpful for you, don't forget to hit the subscribe button. Till next time, thank you for watching Hint Hive. I'm Peter, and I'll see you soon. With the rate at which the topic of stocks and investments is taking over the world as we see it today, many people are pressured into buying things or making investments with things they have little to no knowledge about. And so with today's video, I'm going to be looking at the QQQ ETF for beginners. Going to be explaining some of the things you need to know so you can make informed decisions before making purchases on ETFs such as the QQQ, for instance. So make sure to stick to the end of the video, and if you like this sort of content, don't forget to leave a thumbs up and subscribe to the channel if you haven't. Let's go. As you may already know, the Invesco QQQ ETF is one that tracks the Nasdaq 100 index. Now, due to the fact that it follows this index, the QQQ prices fluctuate alongside the Nasdaq 100. This ETF is known to have about 102 holdings, as well as being the fourth most popular ETF. Now, just like the Nasdaq 100, the QQQ holdings are strongly towards large tech companies. However, this doesn't mean that its exchange has only large tech stocks. It also consists of a few other sectors as well. This is why it is important to know what you're invested in before you start investing. Now, for a little background on QQQ. The QQQ is an ETF primarily owned and operated by Invesco. They as well own the primary shares invested in these individual companies. Hence, that simply means that whenever a share is bought in QQQ, it is also bought by Invesco, as they keep releasing new shares in an open-end fund. So, if you wanted to invest in the QQQ ETF, you need to first find out if you had that in your brokerage. One thing you could do is just go in the search bar and type QQQ, and if this shows up, then you know that you can purchase or initiate the sales of the shares that you have in this fund. It is important to know that 4 times every year, the distributions are paid, which are dividends of a yearly yield of around 0.55%. And alongside this is a management expense ratio of around 0.2%. Using actual numbers as an example, so $10,000 at an annual expense ratio of 0.2% is going to be around $20 for $10,000. Now that that's out of the way, let's look more into the QQQ. The fact that the QQQ tracks mostly large non-financial companies is no news to anyone. But one thing that you should note is that it tracks large tech stocks, which take up most of the fund, around 70%, while the remaining 30% goes to the industrial and utility sector. As it focuses greatly on technology, this ETF provides exposure to a higher growth potential sector. In a particular trade, you're able to access shares from Apple, Facebook, Amazon, and Google. Now that you have a background of this QQQ, let's look at the pros and the cons before you make any investment choices. As for the pros, the first one is its liquidity, as it offers traders the ability to buy and sell immediately at a pretty low cost price. Then there is the advantage of its growth potential. This is because the QQQ is made up of tech companies that produce technologies on a day-to-day basis. Another advantage here is a general advantage that comes with ETF, which is diversifying your risk. No point putting all your eggs in one basket when you can spread it across 100 companies. Another pro, which is relative to some people, is its low expense rate. This helps to improve returns as time goes by, because expenses always go up. Now, as for the cons or disadvantages, something that comes with having high exposure to large tech stocks is the unadvisable high valuation levels or the high risk and volatility, because the technology market is a highly volatile one. And with all of this, it is reasonable to say that figuring out the right ETF for you is based on your investment goals. But no doubt, the QQQ ETF is one of the best choices for investors that want large exposure to tech stocks. It also checks most of the boxes for short-term traders. However, this ETF has the most benefit for long-term investors, as they benefit from the high growth potential without having to worry about cherry-picking stocks. Hopefully, this was able to shed some light on the QQQ ETF in case you were considering making this investment choice. And if you have any questions regarding this, feel free to drop your question in the comment section below and I'll do my best to answer it. Oh, and by the way, if you're new here and you like this sort of content, don't forget to leave a thumbs up and subscribe to the channel so you never miss a video. Till next time, I'm Peter and I'll see you in my next video. Hello guys, and welcome back to Hint Hive. Today, we're going to be talking about renting versus buying a home, which is better for you. If you're new to this channel, my name is Peter, and this channel talks about financial independence, financial literacy, tips and tricks to basically help you grow as an individual and get to achieve financial independence. So if this sort of content interests you, don't forget to subscribe to this channel for more videos. Now, introduction to the home ownership debate. Well, the debate of renting versus buying a home has been going on for a very, very long time. And while it is common in some countries to rent just because of the high cost of living, in some countries, home ownership might be a better option, depending on the prices of houses and depending on the income of the individual that wants to buy a home. If you're watching this channel, I do believe you already know what renting is. Renting is basically when you pay to live in someone else's home. Home ownership is basically when you own the house, and even though you're paying a loan, you have some equity or a portion of investment in that particular house. And one of the major differences between renting and owning a home is the equity you make while you own the home or while you pay off your mortgage loans, as well as the freedom to do whatever you want with your own home as long as it's within city rights or city permit limits. Renting, on the other hand, doesn't give you as much freedom because you can't do whatever you want with someone else's home. The housing market and what it means for millennials. Many millennials are struggling to buy a home due to the high cost of housing at the moment. Housing prices are increasing at unprecedented rates and don't seem to be slowing down anytime soon, making it more difficult for people to save up the down payment. Due to the high prices involved in owning a home, most millennials have opted to go for renting instead of buying a house. This in turn has increased the demand for renting and has also increased the prices to rent a house. Now let's look at the pros and cons to buying a home. Buying a home can be a very exciting experience as well as a very stressful one. And there are many reasons why a lot of people decide to buy a home. The first and obvious one is to build equity. Some people want to build equity and just have a place that is theirs and theirs alone. Others want to invest in a property for the future because they know that the value of the house is going to be worth more than renting down the line. So the major pros for buying a house is one, building the equity. The next being that you own a home that is yours and can't be taken away unless you default on the mortgage conditions. It also comes with a sense of accomplishment or fulfillment that you have something that you can call yours and yours alone. And the downsides to owning a home is, for instance, the major one, which is the budgeting or the down payment. Being the fact that there is no fun until you saved up the down payment or you saved up enough money to buy a house. The other downside I could look at, which is not really a downside, is learning how to do basic repairs to save yourself money. When you're renting a place, you can always call up the landlord to tell him or her that this is what's wrong with your apartment and you have to fix it because I'm paying a certain amount. But when you own the home and something goes wrong, it's your responsibility to fix it. And if you want to fix it for cheap within your skill set, you could opt to learn basic repairs so you don't have to pay for everything every time. This could be stressful for some people as they just want to pay money and just live in a place without having to worry about any repairs or any other thing else. But the question becomes this: how do you figure out if buying a home is a good decision or a right decision for you at the moment? Well, it depends. Here, I'm going to outline a few questions that you have to ask yourself before making the decision to buy a home. As we all know, buying a home is one of the most important decisions as an individual that you're going to make possibly in your entire life, one of the most expensive decisions you're going to make, except you have a multi-million-dollar business. And buying a home is not just about you, it's about where you want to live, where your partner wants to live, if you have any, what the future looks like for you and your family. This is why it is very important to take some factors into consideration when looking at if this is the right decision for you at this particular time. The first question you have to ask yourself is, can I afford to buy a home? This is usually the biggest question, because if you don't have money for the down payment, you don't have money to buy the house. The next question is buying the home mathematically better for me at this point in my life? I'll give you an example. When you're buying your home, just looking at comparing the mortgage to the rent, for instance, when you're renting, all your rent is basically going towards the mortgage of the other person. But to you, that rent becomes the interest. When you own a home and you're paying mortgages, a certain portion of that mortgage goes towards the interest. So if, let's say, 50% of your mortgage goes towards the interest, just throwing out numbers here, and 100% of your rent goes towards the interest, which is money you're never gonna get back, you have to compare between both of them. Let's say, for instance, you're renting for $2,000 and you could get a mortgage for, let's say, $1,000 or even the same $2,000. So $2,000 on one end goes towards interest, you're never gonna see that money back, or $2,000 on the other end goes towards the mortgage, where even if $1,500 goes towards the interest, which is not possible, but let's even say 1,500, or let me make it a little bit more realistic. Let's say 50%, which is 1,000, goes towards the interest. Now you're paying 1,000 that you will never get back on the mortgage here, and you're paying 2,000 that you will never get back on the rental here. Which would be better for you at that particular point in time? Next is, am I ready to commit to paying a mortgage every month? While this one is important, I feel like you don't really have too much of an option here, because you either pay the mortgage or you pay your rental. You're not gonna stay in a landlord's place and not pay the rent. So you are also making a commitment to pay rent, just that this time you're making a commitment to pay the mortgage, which in turn helps you build equity for yourself. Next is, do I want to be tied down by monthly maintenance fees? While most people don't talk about this portion when it gets to owning a home, it's quite important because the utilities and all that when owning a home sometimes get more expensive than when you're renting, depending on where you're renting. So you also have to factor that into the consideration that if you're owning this home, can you keep up with the monthly maintenance fees? Because that could be extra money that comes out of your savings every time. Next is, am I financially stable? Well, this is a tricky one because only you can define if you're financially stable or not. And while we all don't think we're financially stable, sometimes we tend to overthink this, or we undergo analysis paralysis when it gets to owning a home. Always try to make it as simple for yourself as possible. Can I afford this payment every month? Yes or no? Can I afford this rent every month? Yes or no? How much am I saving from going from a rental to owning a home? It doesn't matter the type of house, but how much am I saving? Once you can get those questions answered, then you know if it's worth it for you to buy the home today. Another thing is, do you want to build equity while you're waiting? Because sometimes the home prices keep going up, and except you can save, let's say the home price increases by 20,000 or 30,000 in a year, except you can save up an extra 30,000 in a year between now and the next year, chances are you're better off buying now, so that that 20 or 30,000 could be in your equity when the house appreciates as inflation rises. So sometimes you might not be too comfortable owning a home today just because the prices are so high and everything's so tight, but you also have to think of the future. If I'm not owning a home today, will I be able to own a home next year? But the thing is, if you ever decide that owning a home is not right for you, you also have to come up with a plan to invest the difference. That way you're trying to keep up with the economy and you're not getting poorer as inflation comes in. And with that, we can say now that at some stage in your life, you're always going to be faced with this question of, should I rent or should I buy a home? And your answer would be based on different things happening in your life at that particular time. There is no right or wrong answer to this. Yes, buying a home helps you build wealth, helps you build equity, helps you save in some ways if you have problems saving on your own. But at the same time, renting and investing in the right assets could also make you achieve financial independence. The problem becomes that when you're renting, a certain amount of consistency and discipline comes into play that you have to invest the difference. Otherwise, you're not going to come out ahead compared to buying a home. So to summarize this, renting would be good if you can invest the difference between your rent and the mortgage. Owning a home is also good If that fits your current lifestyle, or your family's expanding, or you're just looking to invest in something and you're not so familiar with other forms of investing like the stock market. And when done well, even though some people could argue that one is better than the other, I believe that as long as it gets you to the same point, it doesn't matter. Just do what works for you and what works for your overall financial goals. With that, I'll leave it here. I like to do more videos on real estate in the future because it helps me deal with stock market returns and hedge against inflation too as well. If you like this content, don't forget to subscribe and leave a thumbs up to help grow the channel. Till next time, I'm Peter, and thanks for watching Hint Hive. I'll see you again. Okay, so have you ever wondered what the S&P 500 is and why people talk about it so much when it gets to investment? In this video, I'm going to be reviewing all you need to know about the Standard & Poor's 500, also known as the S&P 500. The S&P 500 is a stock index that tracks the largest 500 publicly traded companies in the US. It tracks them by market capitalization, or market cap. What is market cap, you might ask? Market cap is simply the total value of a company's outstanding shares. That being said, having a really huge market cap is not all that counts towards making it into the S&P 500. The company also has to be in the US, be listed on a US stock exchange, have a market capitalization of at least $8.2 billion. The company also has to be profitable in the previous 4 consecutive quarters, and have at least 250,000 of its shares publicly traded in the last 6 months. And right here, I want to take a quick break to tell you, don't forget to hit the like button and subscribe to the channel if you haven't to get more content like this. Now, back to the issue. So the top 500 companies that meet that criteria are being tracked by the S&P 500. This leads to a number of companies moving in and out of the index when they do or do not meet those criteria that I mentioned earlier. And just in case you were wondering, the market cap for the S&P 500 is the sum of the market cap for all those companies. Now, that being said, all the companies in the S&P 500 are not considered equal, and the market cap between each of those companies are considered or taken into account using a weighting system. And to simply put this, if the S&P 500 was a pie and there are 500 slices in that pie, each slice wouldn't be equal. The implication here is that the larger companies would have more of an influence on the price of the S&P 500 index than the smaller ones. The reason it is important to know this is because the investors usually look to the S&P 500 to figure out the performance of the stock market. Knowing this, investors can easily use this to know the performance of their portfolio or gauge the performance of their portfolio, or even use it sometimes to create their own portfolio. But on a larger scale, the S&P 500 is also used to know how well the US economy is doing. So basically, if the S&P 500 index is going up, that means the US economy is doing well, and vice versa. Now, going back to personal investments, while you can compare your portfolio to the S&P 500, you can't directly invest in it. And when I say directly, I mean you could invest in something that tracks the S&P 500, but not the S&P 500 itself. And one way of doing this is by investing through ETFs. An ETF is also known as an exchange traded fund, and the idea of this is to mirror the performance of a market index, in this case, for instance, the S&P 500. And how the ETF does this is that it tracks the companies in a particular index, and it invests in just the right combination of those companies to mimic the performance of that index. On your part, this leads to you having a very diverse portfolio and not having to worry about which companies make it to the index or not, because once you invest in those ETFs, they automatically invest in the companies that make it into the index and take out the companies that don't. So without much stress on your part, you could have a very diverse portfolio just by investing in an ETF that tracks the market that you want to track. Now, granted, this is a very passive way of investing. You also wouldn't be making huge or crazy overnight returns because some companies in that index could be underperforming and some would be leveling it out. Compared to if you're investing in single stocks, you would have one-hit wonders, overnight sensations in some cases, and sometimes drastic or dramatic losses. But this is not to say that the ETFs are bad. In fact, the ETFs outperform 85% of the money market managers all over the world annually. Now, if you're looking to invest in ETFs in the US or Canada, there are some top ETFs that you could consider when doing this that track the S&P 500. In the US, you could consider the Vanguard S&P 500 ETF, ticker symbol VOO. There's also the iShares Core S&P 500 ETF, ticker symbol IVV, and the Spider S&P 500 ETF, ticker symbol SPY, are amongst the largest ETFs you could invest in for the US. Now, compared to the other two, VOO is relatively new and it has been around since about 2010. IVV, on the other hand, has been around since 2000, and the SPY has been around since 1993. The implication here is that the SPY has been around the longest, and it has had the time to prove or earn its trust amongst investors. Add this to the fact that it has the largest assets under management, around $367 billion, as well as the highest trading volume, and you can understand why it's considered as the mother of all ETFs. However, there is a catch. It charges an expense ratio of around 0.095, while still yielding the same returns as other ETFs that track the same index. Now, I know a new term came into play there, expense ratio, but this is simply the amount an ETF charges you for carrying out investments for you. So instead of you giving the ETF money, it just deducts a certain percentage from your investments every year. This percentage is typically arrived at by dividing an ETF's operating expenses by its average assets. Now back to the ETFs. Both IVV and VOO charge an expense ratio of 0.03%, with IVV yielding a 5-year average annualized return of around 10.4%, same as the SPY. VOO, on the other hand, has yielded an annual return of approximately 10.5%. However, IVV has larger assets under management, around $295 billion, while VOO has around $265 billion. Now, that's it for the US. Let's switch over to Canada. If you're in Canada, some of the ETFs that track the S&P 500 that you should or you could consider investing in are 1. The Vanguard S&P 500, but instead of VOO, it is now VFV. Another one is the BMO S&P 500 ETF. This is called the ZSP. And one more I could mention here is the iShares Core S&P 500 ETF, ticker symbol XUS. Now, as you would have noticed, the Vanguard and the iShares S&P 500 ETFs have something that you could call the American version and the Canadian version, but there are differences. And one difference is that the Canadian counterparts have lower assets under management. Take for instance, the VFV has just $6.49 billion under management. ZSP has $9.13 billion, while XUS has $4.9 billion. Another difference is that the Canadian counterparts also charge a higher expense ratio. VFV, for instance, charges a ratio of around 0.08%, with XUS being the highest at around 0.1%. However, for helping you invest in American companies and indexes, they actually offer the best rates. And there you have it, a quick rundown of everything you need to know about the S&P 500. Bear in mind that all the ETFs mentioned here are not financial advice, and you should do your own research before investing into anything. Also, don't forget to like this video, subscribe to the channel, and hit the notification bell if you found this video useful or you want to see more like this. Till next time, I'm Peter, and I'll see you in my next video. With the tax season approaching year in year out, many small businesses complain about tax rates and how much they spend on it yearly. If you need a way to save money as a business and write off some of your expenses, here's a video that's going to help you with that. Hey there, welcome to my channel. In today's video, we're going to be looking at top 10 tax write-offs in Canada and explaining what tax deductions are in the process. If you haven't subscribed to this channel, please do so. Give this video a thumbs up and click on the notification bell so you get notified whenever I upload a new video. A tax write-off is another name for a tax deduction. And a tax deduction simply means a channel through which your business can reduce how much you eventually pay as taxes when it's time. The higher your deductions, the lower your business income and your final bill when it comes to the CRA. Now, not all expenses qualify as write-offs. For example, for an expense to be categorized as a write-off, it has to be recognized by the CRA as a cost incurred for the sole purpose of earning business income or running business operations. Here are the top 10 tax write-offs with examples. The first one is travel expenses. Wait, this doesn't mean a trip to LA or Las Vegas with all the crazy bills. This can mean a bus ride or an Uber ride to the next 2 streets. As long as it is related to business activities, it can be a legitimate write-off. For example, if you're a public speaker or a home service agent, any money spent on transport could be recorded and written off, as long as you have the evidence of this expenditure. The next one is advertising or marketing expenses. This includes website ads, radio, TV ads, newspaper, magazine ads, paid search results, and hiring offline marketers to help publicize your business. This counts as a write-off because it is an investment into running of the business and it will in turn produce income for the business. This can also include influencer marketing, which is something that most businesses are running towards nowadays with the rise of social media. Just endeavor to keep all your receipts because you could get audited and you would need to provide them. The next one on the list is professional fees. If your business pays for external help or for certain assignments, you can write it off. If you hire freelancers, accountants, lawyers, consultants, and any other service in line with what your business needs, you can write it off your tax bill. This also includes monthly salaries and wages if you have a team of people working for you in your company. And even if you're a one-man business, any extra hand you hire and pay can be a write-off on your tax when it's time to pay up. The other one is office supplies. Office supplies such as paid subscriptions, which your business works with monthly or yearly, can be written off. If you have a tool you are subscribed to for the sake of your business, you should keep a record of these transactions so that you can present them to the CRA if you're ever audited. Subscriptions such as Adobe Pro, Jasper AI, Grammarly Premium, things like that can be written off when filing your taxes. The other one is food and entertainment. I can see you smiling, but if your business has a lunch allowance for employees or you organize a get-together of some sort, it should reflect on your tax statements and it can be written off as long as you can prove that it happened. If you host a function, fundraiser, or any event related to your business activities and growth, you can try to write it off. As a small business, if you decide to give out to orphanages and charity homes, you can write it off as long as the charity homes or orphanages are registered with the Canadian government. If grants are given to businesses or scholarships to students, they can be written off. Whatever is given out on behalf of your business can be written off as long as you can prove that you did that. Another one here is business use of home expenses. This applies to people who basically work from home. If you're a one-man business and you work from home, you can write off your home expenses or a portion of your home expenses related to that business, such as your utilities, mortgage interest, property taxes, and so on. You can also add a percentage of your rent if you don't own the house. This next one is called professional dues. So as a person, you might be obligated to pay certain bills annually or monthly to keep the status of your business as a registered business. These costs, as heavyweight or light as they may be, can be written off. If you're a doctor or a lawyer or a psychologist and you have to pay for a license to operate, for instance, without these licenses, your business might be shut down, you wouldn't be able to create income, so these can also be seen as expenses that earn your business income and are recognized by the CRA as write-offs. Bank and payment processing fees. If you use a bank that takes a lot of charges from your account when you transact business, you can keep the records and write them off as business expenses. This can also apply to invoice fees, minor deductions here and there. And this gets me to one more point, which is loan interest. If you take a loan on behalf of your business and you have to pay interest on it, it may be pricey, but the good thing about this situation is that those expenses can be written off because it was an expense incurred by the business. With all this video was just to help you understand what type of expenses you should be tracking before tax season comes. This is in no way financial or tax advice, and you should consult a tax professional before filing your taxes. Thank you so much for watching. Don't forget to subscribe to the channel and give this video a thumbs up if you like this sort of content. Till next time, I'm Peter, and I'll see you soon.